Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. The Fed goes big with a 50 basis point cut to fend off mounting risks to the labor market. The chair, Jay Powell, tries to rein in expectations of future moves.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen.
Lebanon is hit with another wave of attacks, with walkie-talkies exploding a day after pagers blew up. Authorities say 26 people have died and more than 3,000 wounded over the past 2 days. Plus, central bank bonanza. More decisions are due today, with the Bank of England being the biggest, but Norway, Turkey, South Africa and Taiwan are also on deck. Well, it has just gone 8 a.m. across the Emirates. I'm Joanna Versace in Dubai, and you know what they say? Go big or go home. So they decided to go big. They went for that jumbo cut. After all, the Fed did decide to cut interest rates by 50 basis points, guiding to another 50 basis points if you look at those dots for the rest of the year, and for the rate to end up at around 3% by end of 2025. And so the reaction in markets, I've got to say, was a little bit confused. Initially, we saw a big spike in stocks. At one point, the S&P was up 1%, but by the end of the session, we pulled back. So the S&P down just a little bit by 0.3% by the time the events had finished for the day and the market had fully digested. But again, sitting very close to record highs. We also saw similar roller coaster price action in other assets. But I want to draw your attention to 10-year yields, because what we saw yesterday was quite interesting in fixed income. Again, it was a case of buy the rumor, sell the fact. After the news came out, by the end of the session, 10-year yields were up 10 basis points on the day. So that 2-10 curve, the steepest for the year, 2024 so far. The market is very squared on that this rate cutting cycle is going to yield further steepening in the fixed income curve. So we'll talk more about that on the show. Gold also up 0.2%, getting to all-time record highs. So money keeps pouring in to the safe haven. And dollar yen also in focus as well. As you can see this morning, you would think that a Fed cutting interest rates by 50 basis points and indicating further easing would be weaker for the dollar, or would imply more weakness for the dollar. Instead, another case of buy the rumor, sell the fact. The dollar has actually strengthened in the last 12 hours, and we're seeing it versus the yen. The yen is 0.6% weaker now. But switching over, it is not just about the Fed. We've got plenty more on the central bank agenda to watch out for. One of the ones that are going to be making their decision today is the Bank of England. You will recall that at the last central bank meeting, they decided to cut interest rates, but it was a very thin margin. It was only 5-4. Wanting to go for that interest rate cut. So today, the vote split is going to be key to watch. No economists are expecting the Bank of England to cut interest rates today. But again, the split will be closely watched, as well as any guidance around the language on how they're thinking about the progression of inflation and, of course, the labor market there too. But let's also check in on how Asia's markets are trading with Min Min Lau in Hong Kong. So far, from what I can see, a risk-on session.
Yeah, Asian markets punching higher on the back of the Fed cut. And of course, the Fed cutting 50 basis points open up a window for the PBOC in China to cut rates as well. And that's why we're seeing the CSI 300 up 0.8%. But it's really the Nikkei 225 that is punching 2.5% higher. That's really boosted by the weakening of the yen. We did see the yen paring back some of those gains after Jay Powell gave that press briefing that suggests that the Fed maybe is not as dovish as people had been expecting. And we're watching the yen very closely because of the BOJ decision on Friday. Economists expecting the central bank to hold rates unchanged. But with the dollar yen rising again, now up 0.6% and away from that danger zone of 140, 141, could that put the possibility of a rate hike back on the table? That's what we are watching for tomorrow.
Min Min Lau in Hong Kong, thank you so much for that overview. Well, I just want to bring you some breaking news that we're getting from Europe, actually. And this is data showing that European car sales have fallen 16.5% to just over 750,000 vehicles sold in August. This is being led by a decline in Germany. So no surprise there. This is something that we've been talking about consistently on the show. But demand for electric vehicles has started to dwindle. And this is showing up particularly in Germany. Listen to this. EV deliveries in the German market plunged by 69% in August to just over 27,000 vehicles. These are according to figures from the European Automobile Manufacturers Association. So big story in Europe. But for now, let's go back and talk about the Fed and what we got out of the Fed chair, Jerome Powell, yesterday, because the Fed has said that the half-point rate cut reflects the central bank's risk management approach as they aim for a soft landing.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. A broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. If the labor market were to slow unexpectedly, then we have the ability to react to that. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%.
Well, let's bring in Yves Bonzon, who is the global CIO at Julius Baer. Wonderful to have you with us on the show. It's a very important day for markets. Let me start off by asking you why you think the Fed opted to go for a 50 basis point cut. Is it because the market coerced them to, or do you think there's fundamental justification here?
Well, I was clearly in the 25 basis point camp.
Yeah.
They were bold, going for 50. The main rationale I can see is the political calendar. We're less than 2 months away from the presidential election. Probably they did 50 because they didn't want to cut another 25 if need be ahead of the presidential election shortly before. The Fed likes to show independence from the political process.
Yeah.
And I think that might be one of the true rationale being going for 50 instead of 25.
Absolutely. Them instead of doing it closer to the election timing.
Absolutely.
What do you make of what the dot plots are telling us? Because they're implying, the median dots are implying another 50 basis points this year, and then we sort of ending up around 3% at the end of 2025. Do you see this as an acceleration of the easing cycle? I
don't think so. I think this highlights growing confidence among FOMC members that the disinflation process is well anchored, higher confidence in reaching their 2% inflation target, while at the same time balancing the risk with a labor market that has cooled. We've seen wage growth for those changing job converging with existing jobs wage growth recently, which is a sign of a labor market that is normalizing. So I think they want to balance the risk. And again, inflation behaved very, very well. That means real rates have gone up. So they made that 50 basis points cut move. It doesn't mean they're going to cut as fast or slower than what the dot plot chart indicates, you know. And historically, sometimes the dot plot chart was completely off the mark.
Yeah, I saw a few comments yesterday initially when the decision came out that the Fed had decided to opt for a 50 basis point cut, that this could be a warning sign to the economy. And many people were saying, what do the Fed know that we don't know? It must be deteriorating. The economy must be deteriorating a lot faster than the market has been penciling in. Equally, there's another view out there that because rates are so restrictive and inflation is close to target, they just need to bring down the rate to closer to neutral because we're close to the inflation stability target.
One of the reasons I was in the 25 basis cut camp is because I was concerned about potential interpretation of the kind they know something we don't know, right? That doesn't seem to be the case based on the market reaction so far. I think critically, we had a very unusual cycle, you know. Previous expansion recession cycle in America were debt-driven. And when you tighten monetary policy after an increase in debt and leverage in the system, the impact is much stronger than it was this time around. The question now, you have private sector with reasonably healthy balance sheet, both in the household and corporate sector. How will rate cuts transmit to the system? And in this respect, there is a risk that actually they underestimate the extent to which it will stimulate credit demand.
Yeah. What your point is saying is that they will be enacting a lot more loosening than they originally envisaged.
Well, if the credit cycle starts again stronger than expected, actually there might be more rate cuts discounted than actually will happen.
Yeah. What do you make of the market reaction? It feels like markets really didn't know what to do here. Usually it takes a couple of days for people to digest. Yeah.
Well,
I mean, the S&P is still close to record highs, all-time highs. Where do you think we go from here?
Well, actually, we think the market is in urgent need of a consolidation. We had a couple of attempts this year in April, again, late July, early August.
Yeah.
Beginning of September, the first part of the month was quite hectic. First week was down 4. We recovered on the second week of the month. One of my concerns, is if that consolidation does not take place, we still believe we're in a primary bull trend, but the longer it takes for that consolidation process to be complete, the more likely we are actually in a much broader top formation for the S&P, because today, in everything we look at, the market is priced for normalization of interest rates, of inflation, normalization of the labor market, the perfect soft landing scenario. It's priced in.
Yeah.
So the question is, what will the market be pricing 6 months from now? Is it a recovery of the credit cycle and therefore an economy that is stronger than expected? Or is it more difficulties in the economy, further cooling down of the labor market? This will be the decisive factor for the direction of stocks in the next 6 months.
And when you think of global asset allocation, how are you thinking about where you want to invest? Because nothing screams to me as particularly cheap here. Stocks aren't cheap. Fixed income, depending on where you think the rates market ends up, not necessarily cheap. Gold at record highs. Where do you put your money, and how are you thinking about it?
You nailed it. Unfortunately, we are in one of those moments when things are priced in a very unprovocative manner. There are, broadly speaking, 2 outliers. You alluded to the struggles of the European car industry.
Yeah.
Obviously, car manufacturers in Europe are very, very cheap. But you've summed up the numbers. I'm not sure you want
They're cheap for a reason.
to take the other side of that bet. Their struggle might last for longer. And obviously there is China. But China is in a balance sheet recession. All the macro indicators point to more struggle going forward. So we still consider China a potential value trap.
Okay, well, fascinating to talk to you. That was Yves Bonzon, Global CIO at Julius Baer. Thank you for the broad discussion. All right, so we are getting some lines. We just ended our conversation talking about China. I want to bring you some lines that are just crossing now. HSBC has cut the Hong Kong prime rate for the first time since 2019. So they have cut the best lending rate from 5.875% to 5.625%. Again, ties into the conversation we were just having about some of the weakness that is popping up from the Chinese economy and more broadly in the region. And the fact that HSBC have cut their prime lending rate does tell you that, again, there is pressure to ease some of these credit lending standards. So that is coming through this morning. Breaking news from HSBC. And still ahead, a new wave of exploding telecoms devices in Lebanon has ramped up tensions between Israel and Hezbollah. We discuss what this means for the region with Karen Young, senior research scholar at Columbia University, next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Lebanon was hit with a fresh wave of exploding telecommunications devices on Wednesday. Lebanese authorities say the blast killed at least 26 people over 2 days and wounded more than 3,000. Hezbollah and the Lebanese government both blame Israel for the audacious assault, but Israel has not commented.
What I can tell you is we were not involved in yesterday's incidents or today's in any way, and I don't have anything more to share. It's too soon to know if what happened over the last couple of days is going to have any effect on where we are with the ceasefire deal. Sadly, we aren't any closer to that now than we were even a week ago. So It's difficult to see any immediate impact of these incidents, but I think it's just too soon to know in general.
Obviously, the logic of making all these devices explode, indication that this event confirms that there is a serious risk of a dramatic escalation in Lebanon, and everything must be done to avoid that escalation.
So a serious risk of dramatic escalation. Let's bring in Karen Young, senior research scholar at Columbia University. Well, no doubt the very shocking developments in Lebanon over the last 2 days have put Lebanon squarely on the map. I just wonder if you are also of the view that this could lead to, in the words of Guterres, a dramatic escalation in the region.
Unfortunately, I do think so. We're seeing the center of gravity of the conflict moving north to Lebanon. And, this means that there's a higher risk of the conflict then spreading. These device attacks also happened in Syria. And so with the, casualties also affecting an Iranian diplomat. So we're very, very quickly moving into both an expansion of territory and the expansion of risk of direct intervention by Iran with Hezbollah against Israel.
So Israel, even though they have not directly claimed responsibility, seem to have targeted Hezbollah's telecommunications network, decapitating or removing the ability for many of these group members to actually communicate with each other. Should we read this as a precursor or the first move towards what might be an eventual full-scale operation into Lebanon?
Yes, I think so. And Israeli officials have essentially said as much, that they're moving forces towards the Israeli northern border in anticipation of a widening conflict, away from Gaza and towards Lebanon.
How in practice can Israel set about achieving security on the northern border? We heard from the Israeli Prime Minister 2 days ago, at the day of the first attack, that they've opened up a new war objective. Yesterday, we heard from the Israeli Defense Minister saying that this is a new phase of the war, that they're deploying military forces to the north. But what can they actually do to ensure that security returns to the border so that citizens from Israel can return to their homes in the northern part of the country? What does that look like in practice?
Well, I mean, as the stated objective is to, return people to their homes, opening the conflict at the border probably does not do that in the short term, certainly, but it indicates to citizens that the government is doing something. And I think for political reasons, that's why you see Netanyahu making these announcements. And you see this kind of change in posture and the use of this kind of unconventional warfare against Hezbollah just over the last 2 days.
The Iranian ambassador was also harmed in Tuesday's attacks. There are reports of some of the injured actually being shipped over to Iran via Iranian Red Crescent. To what extent do you think Iran might also be embroiled in this conflict should, as you say, it evolve into an all-out war between Lebanon and Israel?
Well, there's always the question of how Iran sees Hezbollah and how they want to use Hezbollah and how they might want to protect them. But then, there's the separate issue of, having a member of the Iranian government, of a diplomat, being personally attacked. So I'm sure that you will hear commitments of reprisals and we get into this cycle of retaliation. And now it's hard to even keep track of what event is responding to what as we get into this sort of escalation and continued cycle of violence.
Yeah. Another big development yesterday that many people and geopolitical analysts were pointing out is comments from the Saudi Crown Prince, MBS, where he said pretty explicitly that hopes of a normalization deal with Israel will be completely put on track unless there is a recognition of a Palestinian state with East Jerusalem as its capital. How do you read those comments?
Well, it was a change in tone and posture. I mean, the Saudi government and the Crown Prince had been more open to the idea of normalization with a path towards a Palestinian state. That language is now much more concrete, that the state comes first and normalization comes later. And so this is a response, of course, I think, to how citizens in Saudi Arabia feel about the plight of Palestinians and the violence in the region. But it also signals, I think, a closing of some diplomatic windows and perhaps expectations of what could be achieved from the Biden administration in terms of a ceasefire and in terms of some sort of movement in negotiations much broader towards the establishment of a Palestinian state.
Karen, good to talk to you today. Karen Young, Senior Research Scholar at Columbia University. Thank you. Now, still ahead, the central bank bonanza continues. We discuss what the Bank of England and South African Reserve Bank may decide when they meet today. More details later in the show. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. U.S. authorities have accused Iranian hackers of emailing stolen information from Donald Trump's campaign to President Biden's campaign team, as well as to journalists. The operation appears to be an effort to dupe people working for the Biden campaign to act on spear phishing emails. Now, investigators don't have any evidence that anyone from Biden's team replied to the emails. While the tennis season's Grand Slams are behind us, there's still action on the court as the sports superstars descend on Berlin for the Laver Cup. Some of the world's most famous retired legends, including John McEnroe and Bjorn Borg, are already courtside. Speaking to Bloomberg, former world number one McEnroe criticized the idea that there is too much money in tennis.
Even now, after the amount of money that's paid at the U.S. Open, which is record money compared to what we were getting, 14% of, and that's including the women, out of the revenue. I mean, that doesn't seem to be totally fair, and that happens at all the big events. And I don't want it, I don't think you have enough time to get into sort of the machinations of what goes on, but let's just, needless to say that we're just like hired guns.
John McEnroe, characteristically outspoken. All right, coming up, we're going to be looking ahead to the Bank of England's rate decision due in a few hours, with traders awaiting more hints from the governor on the central bank's rate path. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. The Fed goes big with a 50 basis point cut to fend off mounting risks to the labor market. Chair Jay Powell tries to rein in expectations of future moves.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen.
Lebanon is hit with another wave of attacks, with walkie-talkies exploding a day after pagers blew up. Authorities say 26 people have died and more than 3,000 wounded over the 2 days. Plus, central bank bonanza. More decisions are due today, with the Bank of England being the biggest. Norway, Turkey, South Africa and Taiwan are also on deck. It has just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. And yes, we finally got some clarity on the Fed. They cut 50 basis points. They went for the jumbo rate cut after all. But later on in the press conference, the Fed chair sort of signaled that markets shouldn't get used to this type of increment looking ahead, even though the median thought suggests that another 50 basis points of cuts could be coming this year, and that will end up somewhere around 3% by the end of 2025. So markets didn't really know how to digest all this data. Initially, we saw a big spike up in stock markets. The S&P at one point was up 1%, but by the end of the session, we had tipped a little bit lower, so down about 0.3%, marginally so. Though I do want to mention that today the handover from most of Asian stocks has been positive. We'll talk about that in a moment. 10-year yields, lots of interesting price action there, because once the decision became apparent, what we saw was, again, a little bit of volatility around the moves, but ultimately we ended up up 10 basis points higher on the session. So we moved up quite substantially in terms of the 10-year part of the curve. The curve did steepen. 2 stands at its steepest level for 2024. Gold also in focus. More money poured in to the safe haven. It is now at a record high, so something to bear in mind. And then dollar yen as well. What we did see is by the end of the session, the dollar had actually started to trade firmer versus other currency pairs. The yen obviously in focus again at one point. The yen was 1% weaker versus the USD this morning. All eyes on the Bank of Japan meeting tomorrow. But let's switch over and just talk about some of the other central banks that are coming out with decisions today, because we've got decisions from Turkey, from Taiwan, from South Africa. But this is just a chart really showing the terminal rate of the Bank of England. And you can see, not the terminal rates, rather the overnight rates. And we're trading now at 5%. They, of course, cut interest rates at the last meeting, but it was a very finely tuned decision. 5-4. We're going to speak to Lizzie Burden shortly about what we can expect out of today's decision. All right, let's also check in on how Asia's markets are trading with Min Min Lau in Hong Kong. Min Min.
Yeah, it's risk-on sentiment here across Asia. The benchmark is up 1.2%, but it's really led by the Nikkei 225, which is punching up 2.5%, really boosted by the weakening of the yen, which is good for the nation's exporters. But shares across China, Hong Kong and Taiwan are gaining as well. The Hang Seng up 1.8% after the Hong Kong Monetary Authority matched the Fed cut by cutting rates by half a percentage point to keep that currency peg in place, and that's good for Hong Kong's businesses and consumers. And of course, PBOC now in a window to cut rates as well in China after the Fed had moved with that 50 basis points cut. Let's flip the board, take a look at the yen. It had erased most of the gains after J. Powell's comments came in that suggested maybe the Fed wasn't as dovish as people were hoping it would be. And we're watching the BOJ decision tomorrow closely. Economists expecting rates to be unchanged, but with the yen, dollar yen now moving up 0.6%, maybe that could put the possibility of rate hike back on the table. Jumana?
Yeah. Min Min, thank you so much for the overview. Min Min Lau in Hong Kong. Now, the Bank of England is expected to hold rates steady at 5% today, with economists predicting the next leg lower may come in November. Traders are awaiting the Bank of England decision a day after the Fed lowered its own benchmark interest rate by a half percentage point. Let's bring in our UK correspondent, Lizzie Burden, who joins us now from London. Lizzie, well, over to the Bank of England now. We got clarity on the Fed. They cut interest rates by 50 basis points. Does it have any bearings at all on what the Bank of England may decide to do today? The last meeting, of course, it was a very close decision to actually opt for that 25 basis point cut.
It was indeed, and as you know, central bankers like to insist that they all have their own minds, and the Bank of England is no exception. But of course, what the Fed does impact the Bank of England via the exchange rate, and a higher pound would mean weaker growth. And this is why even before the Fed cut by 50 basis points yesterday, as markets were pricing in the chance of that increasingly, bets on a BOE cut today were also ramping up. But Jumana, yesterday we had the CPI data for the UK bang in line with expectations at the headline level, but in line at the services level, but a ramp up, a significant ramp up. Yes, it was less than the Bank of England's forecast. Yes, it comes down to volatile inputs like airfares. But this is a sticky part of inflation that the BOE has expressed concern about. And if we think back to Jackson Hole, Andrew Bailey's approach is cautious. So this is why the expectation among economists remains that the BOE is going to keep rates on hold today. And it'll actually, our economists expect, be less finely tuned than that last meeting, even though we've got an unknown figure on the committee this time in the form of Alan Taylor.
Yeah, I mean, so you have to think about it from both perspectives. The inflation, the headline inflation rate, 2.2%, very close to 2%, but some elements still sticky. Growth has been flatlining in the UK economy. I know today isn't a day when we're going to get updated economic projections, but what is the market going to be watching out for in terms of clues about Bank of England's future path?
You're absolutely right. No forecast, but they could still nod to lower inflation and lower growth than forecast, given all of that recent suite of data. And I think if you look at the path ahead, at the moment, markets are fully pricing in cuts for November and December, 5 cuts for 2025. But they'll have more of an idea of what the economy is going to look like by November, because, of course, on October the 30th, we get the Labour government's first budget. Now, the Chancellor, Rachel Reeves, is looking to close this £22 billion hole in the public finances. The speculation is that it's going to be an austerity budget with tax rises. And indeed, if it is a fiscal tightening, markets have yet to fully price in what the slowdown in the economy would entail and what that would mean for the Bank of England.
Lizzie, thank you so much for the preview. Let's see what happens in, what is it? How many hours time? 7 or 8? I've lost track. Lizzie Burden, thank you so much. All right, let's turn to the U.S. Traders are ramping up their bets on the pace of the Fed's rate cuts. Markets are now pricing in about 70 basis points of easing this year. Treasury yields rose after 5 straight months of declines following the half-point cut. Bloomberg's executive editor for Asian markets, Paul Dobson, joins us for more. Well, Paul, I'm going to start with the reaction that we had in Treasury yields. I was a bit surprised to see the 10-year yield and 10 basis points higher yesterday on the session. What do you think is going on?
Yeah, slightly counterintuitive for the Federal Reserve to cut interest rates and yet for bond yields to rise. And I think, what's really important to listen to here is the entire message from the Fed. So although they started aggressively, what they were saying is that doesn't necessarily mean that the next cut is also going to be 50 and the one after that. In fact, Jerome Powell was quite emphatic that this isn't necessarily the series of larger rate cuts that the market might want to price in. And if you look at the dot plot, again, there's that similar kind of expression from the Fed board where they're saying only 25 basis point cuts at each of the next 2 meetings until the end of the year. And we even had a dissenter on the FOMC, which is quite unusual, only voting for 25 basis points of cuts initially. So it tells you the Fed doesn't want to go all that hard or all that fast, having gotten out of the blocks quite quickly. So the market is sort of absorbing all of this and thinking, well, if it's not going to be cutting that aggressively, then maybe our framework for how bond yields develop from here isn't quite right. Maybe actually the Fed isn't going to cut as aggressively or as deep as we first thought. And indeed, Powell talked about that a little bit as well. He said, the long-term interest rates, the neutral rate might be higher now than we'd initially thought. It might be higher than pre-pandemic, which means the longer-term yields would not be so low either.
Yeah. Well, let me also turn to the dollar here because, again, a bit of an unexpected reaction there, too. Today, we are slightly softer, but broadly speaking, after the interest rate decision came out, the dollar traded stronger. And I'm watching very closely dollar-yen as a currency pair as we head into that Bank of Japan meeting. The assumption was that Fed cutting rates would be a catalyst for the yen to continue its appreciation. Instead, the reverse has happened. What do you think is going on there?
Yeah, Jimana, it's the same story. Higher interest rates in the US supports the dollar, basically. So people are buying this idea that the Fed going hard early means that it doesn't have to go so deep with the rate cuts over the long term, that it can help secure that soft landing for the US economy, which overall will support the dollar relative to currencies all around the rest of the world. So for Japan, a bit of a lucky escape there. The concern was that the Fed was going to signal 50 basis point cut, and then the market was going to read into it deeper cuts, more aggressively coming through, and that would really weigh down on the dollar. In actual fact, hasn't happened, and so it's allowed the yen to weaken against the dollar as it pushed up the US currency as a result. And that's good news, a little bit of relief for Japan, given that the Bank of Japan wants to carry on hiking interest rates. Now it's got a little bit of room and cover and breathing space to get away with doing that.
We were just reporting earlier that HSBC has lowered its prime lending rate. And of course, this is after the Hong Kong Central Bank Monetary Authority also lowered interest rates. What sort of knock-on effect can we expect for the Asian market, the Asian region, on back of this interest rate cut out of the Fed? Will they also have to go bigger because the Fed went bigger?
I think, again, it's some relief for Asian central banks right across the region. Hong Kong is a bit of a special case because it's its currency peg against the US dollar, so they automatically follow what the Fed does. But across the rest of the region, there is that opportunity now for central banks to think, OK, maybe we've got a little bit of space to start cutting as well. For a long time, they've been constrained because the Fed had been holding its interest rates so high that had been leading to relative strength in the dollar and pressuring the currencies all across the Asian region. Now that pressure is relenting. interesting. And they think that they can reduce monetary policy, have it a little bit less restrictive without risking a big deterioration in their currency, a big weakening from here. And so we're likely to see more of the central banks starting to come across that from here. We saw the Bank of Indonesia already got out ahead of the market with a cut yesterday. And so probably not all at the same pace, but across the region, from all the way from Korea to India, we're expecting to see sort of cuts coming through steadily through the rest of the year.
Yeah, very clear. Paul, great to have you on. Bloomberg's executive editor for Asian markets, Paul Dobson. Now, also coming up, South Africa's inflation dips below the central bank's target for the first time in 3 years ahead of today's rate decision. We are live in Johannesburg next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. The South African Reserve Bank is set to kick off an easing cycle when it meets later today. It is widely expected that the bank will lower its key rate by 25 basis points to 8%. That's after annual inflation fell below the midpoint of the central bank's target range in August for the first time in more than 3 years. So Bloomberg's chief Africa correspondent Jennifer Zabazaja joins us now, paying close attention, obviously, to this inflation data, as all central banks are around the world, coming at 4.4%. Of course, just below that midpoint of their target range of 3 to 6%. Does that set the stage then for the bank to start their own easing cycle?
Right. Good morning, Jumana. I mean, largely among economists and analysts, there seems to be a consensus that, yes, that is what we will see from the SARB today. An easing cycle will begin, especially if you consider some of those data points that you were just mentioning there were surprising to the downside that we got on Wednesday, especially if you consider what we've seen over the past 2 years from the SARB. They've been able to bring inflation down from 7.8% to now, what you just described there, the midpoint of their target range. So potentially they feel upbeat about this, and potentially then that opens the door then for easing. But largely among economists, there seems to be a consensus that they're not going to go too big. I heard you saying too big, go big or go home, which is what we saw from the Fed. Not necessarily what we're going to see from the SARB. They are still paying close attention to potential inflationary risks that are out there. And of course, they're paying close attention to the currency and potentially exchange rates that could be impacted, and also the differentials between the U.S. and South Africa. So yes, the indication is that we will see a cut today, but it will likely be that the 0.25%, as you were mentioning there.
Yeah, you talk about those yield differentials versus the U.S. And of course, the Fed did go for that jumbo cut, 50 basis points. How is that likely to get factored in to their decision making today?
It's a lot of what a lot of these central banks are focused on, because they don't want the differentials to narrow too much, because then potentially investors look to other markets. And so largely a lot of our reporting is based on the fact that central banks across Africa in particular are paying close attention to this. And when we just think about some of the other central banks that could be as well following South Africa in terms of starting their easing cycle, the expectation is potentially Mozambique, Kenya, Ghana, Eswatini. Not necessarily in that list, though, which is important to note, is Nigeria and potentially Angola holding off on starting that easing cycle, potentially just pausing for now, even though they are seeing inflation cool, potentially even peaking over the past few months. But again, they have a lot of things to factor in. There is the currency, there is the rate differential, and there are geopolitical risks, especially if you consider Angola and Nigeria, who receive a majority of their income from oil revenues. And so there's a lot to factor in for these central banks, but we're going to pay close attention to that.
Yeah, I was just taking a look at the world currency ranker, the terminal, and the South African rand is actually the second best performing African currency this year.
Yeah.
It's up 4% versus versus the USD, the best one being the Kenyan shilling, but does tell you that they do have room to potentially go for this easing cycle, start the easing cycle.
Yeah.
Jennifer, thank you so much for the preview. Bloomberg's chief Africa correspondent, Jennifer Zabazaja. Now, the global vaccine alliance known as Gavi is purchasing 500,000 mpox vaccines from Bavarian Nordic for African countries hardest hit by the lethal outbreak. Gavi CEO Sania Nishtar told us that the jabs are for distribution this year.
We've just entered into a purchase agreement with Bavarian Nordic for 500,000 doses of the mpox vaccine. And this agreement was signed just 35 days after the global public health emergency was proclaimed. And in terms of your question, why now? There is a need for these doses on the ground. We're very humbled that we were able to act very quickly to put this arrangement in place. And part of the reason why we were so successful in moving so quickly is because in June this year, a new financial instrument was created at Gavi called the First Response Fund. The structuring of this fund was based on the learnings from COVID-19, where it was felt that immediately there isn't a pocket of resources available to draw into to procure vaccines for the delivery costs. So this instrument was put in place, and the purchase of these 500,000 doses represents the first time that there is going to be a drawdown from this fund. I'm very pleased to let you know that this represents the largest single assignment of vaccine doses in response to the mpox emergency.
We also wanted to get your take on the pricing, because that's been a lot of the discussion around the mpox vaccine, in particular, just how expensive it is. I wonder, did Gavi have any negotiating power or flexibility to work with Bavarian Nordic to bring the price down, potentially negotiate a cheaper price?
As we were actively in negotiation with them, I myself had a conversation with the CEO of Bavarian Nordic. We tried to, we have done whatever we can to bring the costs down.
And what were your efforts? I mean, what actually came of that?
So we did the best that we could. And we have a commercial transaction with Bavarian Nordic, and according to that commercial transaction, there are confidentiality clauses, and because of that, I'm unable to share the actual price with you.
Welcome back to Horizons Middle East and Africa. I'm Jumana Bersechi in Dubai. Well, returning back to the news we broke earlier in the show, European car sales for the month of August fell more than 16%, painting an ugly picture across one of the most important auto markets in the world. For more on this, Bloomberg's Oliver Crook joins me from Berlin. So just more bad news, Ollie. You've been reporting about some of the headwinds facing the European auto industry. The numbers also today confirmed that this momentum is continuing.
Yeah, there's a lot of questions about macro demand for the auto sector, and if you want to look at what that demand is in Europe, it's really very poor. In the month of August, down 17% in all of Europe. That brings the year-to-date figure of just a little bit of growth of car sales for this year, 1.5 or 1.7%. You go down into the key markets, Jumana, and it's just ugly here. Germany down 30%, just about. France down 25%, Italy. And when you look at the winners and losers from the brands, you look at Volkswagen, their sales were down 13% in August. Stellantis, really the big loser in the month of August, down almost 30%. BMW down 15%, Mercedes down 10%. And of course, critically, the one that we all care about, that everyone watches, is Tesla, down 36% in the month of August. Is absolutely very poor figure. And the context for all this, Jumana, is a very difficult time for the auto industry, particularly in Germany, where you had that recall on the brakes for BMW. But of course, Volkswagen now talking about closing factories for the very first time in their history, an absolutely crucial moment for them.
Yeah, and not good signs coming out of the EV sector as well. EV deliveries dropping 69% in Germany in August.
Yeah. So listen, it's even worse for the EV sector. You go through these numbers. In the month of August, down 36% across Europe. When you look at Germany, down 70% in the month of August. That has to do in part because there were subsidies in play last year, which they've taken away. That, of course, have had a major impact on the sales. There is one bright spot, which is the UK, where EV sales were up about 11%. But what I think is really interesting when you think about the sort of different mixes that are going into these different cars, and you go to the types between gas, battery electric, and hybrids, there is some positive news. Gas sales were down, admittedly, 18% across all of Europe for the month of August. EV sales, as we've been discussing, down 36%. But the hybrids are the big winners, up 8% in the month of August. That brings their year-to-date sales for this year in Europe up 20%. So if people are not buying EVs or gas cars, they're splitting the difference. They're getting the hybrids.
That's so interesting. I guess maybe that's a reflection of people's perception that there isn't enough infrastructure in place to go totally electric. And so hybrid seems like a good compromise for those wanting to move electric. A little bridge, yeah. Ollie, thank you so much for the reporting. That was Ollie Crook in Berlin. Okay, well, so many central banks the last couple of days, but let's just leave you with a picture of equity futures because things are looking positive after that jumbo cut out of the Fed. S&P futures 1% higher, NASDAQ futures 1.4% higher, and Euro Stoxx futures up 1.2% as well. This is a picture for treasuries too. All eyes next will be on the Bank of England in about 7 hours' time. That was Horizons Middle East and Africa. I'm Jemana Bersachi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.